Here is a question that stops most couples in their tracks. What happens to your retirement savings if one of you does not work? If you assume the non-earning partner simply misses out on building a nest egg, you are leaving thousands of dollars on the table every single year. The Spousal IRA loophole is one of the most powerful and underused retirement strategies in the United States, and as of today, the 13th of July, 2026, it remains wide open for couples who know how to use it. A working spouse can fund not just their own individual retirement account, but their partner's as well, effectively doubling the household's retirement contributions on a single income. Financial experts at Yahoo Finance flagged this strategy this very weekend as one of the smartest moves a couple can make before the year is out. So if you have never heard of it, you are in the right place. Under standard United States tax rules, you can only contribute to an individual retirement account if you yourself have earned income, wages, salaries, or self-employment earnings. The Spousal IRA is a fully legal exception built into the tax code. It allows a married couple filing their taxes jointly to make IRA contributions on behalf of a spouse who has little or no earned income of their own. This could be a partner who has stepped back to raise children, care for an elderly relative, pursue further education, or manage the household full-time. The two essential requirements are straightforward: the couple must file a joint federal tax return, and the working spouse's total earned income must be at least equal to the combined amount contributed across both accounts. That is it. No complex paperwork, no special approval required, just a second account in the non-working spouse's name. Let us talk figures, because this is where the loophole becomes genuinely powerful. For the tax year 2026, the standard IRA contribution limit sits at $7,000 per person. Using the Spousal IRA strategy, a couple can together contribute up to $14,000 annually into tax-advantaged retirement accounts, all funded from one salary. If both partners are aged 50 or over, the catch-up contribution rules push each individual limit to $8,000, bringing the household total to $16,000 per year. On top of this, if the working spouse also participates in a workplace 401k, the backdoor Roth 401k loophole, widely reported this week by 24/7 Wall Street and AOL, allows high earners to shelter an additional $8,600 tax-free in 2026. Stack these strategies together and the compounding effect over 2 or 3 decades becomes truly extraordinary. When setting up a spousal IRA, couples face an important fork in the road: traditional or Roth? A traditional spousal IRA provides a tax deduction today, reducing the household's taxable income in the current year, but withdrawals in retirement are taxed as ordinary income. A Roth spousal IRA offers no immediate deduction, but the money grows entirely tax-free, and qualified withdrawals in retirement carry zero tax liability. For most couples where one partner earns a moderate income, the Roth version tends to deliver the stronger long-term outcome. However, higher earners must be aware that Roth IRA contributions are phased out above certain income thresholds. In 2026, the phase-out for couples filing jointly begins at $236,000 of adjusted gross income and eliminates direct Roth contributions entirely above $246,000. Above that ceiling, the backdoor Roth conversion strategy becomes the relevant route. Let us put this into a concrete scenario to illustrate the true scale of the benefit. Picture a couple, Sarah and James. Sarah works full-time as a nurse, earning $60,000 a year. James has stepped away from his career to care for their 2 young children. Without the spousal IRA, only Sarah can contribute to an IRA, sheltering $7,000 annually. With the loophole applied, the couple contributes $7,000 for Sarah and $7,000 for James, $14,000 per year in total, all on one salary. Over 30 years, assuming a conservative 7% annual return, that additional $7,000 per year in James's account could grow to roughly $700,000. That is the real-world difference between a comfortable retirement for 2 people and a financially strained one, all from a rule that already exists and requires no special qualification to use. The mechanics of establishing a spousal IRA are refreshingly straightforward. The non-working spouse opens their own individual IRA account in their own name and social security number. This can be done through any major brokerage such as Fidelity, Vanguard, or Charles Schwab, often in under 15 minutes online. Contributions can then be made from any source of household funds, including joint bank accounts or the working spouse's pay, provided the combined total across both IRAs does not exceed the working spouse's earned income for the year. Crucially, the deadline to make IRA contributions for the 2026 tax year is the 15th of April, 2027, the U.S. federal tax filing deadline. That means couples who have not yet started still have a meaningful window to act. Once the account is open and funded, the most important next step is to immediately select your investments rather than leaving the contribution sitting idle in cash. Even with a strategy this accessible, there are mistakes that can prove costly. The most common error is overcontributing. Exceeding the annual limit triggers a 6% excise tax on the excess amount for every year it remains in the account, which compounds painfully over time. Couples must also confirm they are filing a joint federal tax return. Married individuals who file separately are entirely ineligible for spousal IRA contributions. A third and frequently overlooked mistake is failing to invest the contributions once they arrive in the account. Simply depositing money into an IRA without selecting an investment means the funds sit in a cash position, earning almost nothing. Forbes has consistently highlighted this as one of the costliest errors in retirement planning. The contribution is only the beginning. Finally, do not confuse the spousal IRA with a joint account. Each IRA is legally owned by one individual and cannot be jointly held. Looking ahead, the spousal IRA loophole shows no sign of being closed by legislators, and growing awareness of it is steadily shifting how couples approach retirement planning. With more households choosing flexible arrangements, one partner working full-time while the other focuses on family or caregiving, the non-earning spouse scenario is becoming increasingly common. Fidelity noted earlier this year that awareness of the spousal IRA remains surprisingly low relative to its potential impact, which suggests the majority of eligible couples are still not using it. As retirement savings rates across the United States continue to trail recommended benchmarks, financial planners anticipate significantly greater uptake of this strategy over the coming decade. Couples who act now, building two properly invested retirement accounts simultaneously on a single income, are positioning themselves well ahead of most of their peers in the long-term savings race. The spousal IRA loophole is not a gray area, not a tax dodge, and not a strategy reserved for high earners or financial experts. It is a fully IRS-approved mechanism, clearly written into the tax code, that allows married couples to double their annual retirement contributions on a single earned income. For any couple where one partner earns less or nothing at all, the cost of ignoring this loophole is enormous, measured not in hundreds but in hundreds of thousands of dollars over a working lifetime. The steps are simple: open a second IRA in your non-working spouse's name, contribute up to the $7,000 limit, invest the funds immediately into a diversified portfolio, and file your taxes jointly. The 2026 contribution window remains open until the 15th of April, 2027. If you have not set this up yet, today, the 13th of July, 2026, is the right moment to begin. Your future selves will thank you.